The content of this video is for informational and educational purposes only. It does not constitute political, legal, or professional advice. The information presented is based on verifiable public sources. Please consult with qualified professionals and official sources for important decisions related to political or legal matters. You know, I've been watching what's happening in Washington these days, and I've got to tell you, it's something else. It really is. I've analyzed a lot of presidencies over the years. Republicans, Democrats, landslides, squeakers, scandals, resignations. I've watched markets crash, recover, crash again, and then climb to heights nobody thought possible. But what we're seeing right now with this impeachment move against Donald Trump, this is not what anybody had penciled in for 2025. Not really. And I don't say that lightly. Look, I've always tried to focus on the facts and the numbers. I look at data, at real information, not at campaign slogans or political theater. But when politics starts shaking the foundations of markets, when it puts real pressure on investor confidence, when it injects the kind of uncertainty that keeps business leaders staring at the ceiling at 3 inches the morning, well, then I think it's worth talking about. And what we're looking at now, it's worth talking about. What was supposed to be a tough but manageable second Trump era, a bumpy road, sure, but still a road has turned into something very different. We're not just talking about routine investigations, normal partisan fights, the usual background noise that markets are perfectly capable of ignoring. We're talking about something far more serious. Impeachment articles being filed in Congress, not at the slow, grinding pace Washington usually works in, but as a strategic political move after a series of events that even seasoned observers didn't expect to see this soon. And on top of that, you've got reports of potential cabinet changes, public loyalty, private concerns, leaked information, anonymous briefings. You stack all of that together, and it paints a picture that's hard to ignore. A presidency that isn't just embattled. It's facing significant challenges. Now, I want to be clear about something. This impeachment effort didn't start out of nowhere. These moments never do. They're not lightning bolts from a clear blue sky. They're the result of accumulated tensions that have been building for a long time. People like to say, it all happened so fast. But if you step back, you see the pattern. For months, there have been investigations, committee hearings, discussions about executive authority, legal teams working overtime, staffers rotating in and out, cabinet officials sometimes giving contradictory statements. And all that time, markets have been watching nervously, quietly. They may not care about the daily noise of politics, but they care very much about one thing. Can the system still function predictably? According to public records from Congress.gov, Representative Al Green from Texas announced on November 20th, 2025, that he would file articles of impeachment against President Trump before Christmas. This marks his 5th attempt to impeach Trump. The resolution, H-Res 537, was introduced with privileged status, which means the House must consider it within 2 legislative days. Now, some experts suggest this impeachment effort is largely symbolic. The House has a Republican majority, and previous impeachment articles filed by Representative Green were quickly tabled. In fact, when a similar resolution was brought to a vote in June 2025, it was tabled by the House, meaning it was effectively killed before any real debate. But here's what matters from a market perspective. It's not always about whether the impeachment will succeed. It's about what the constant political warfare does to confidence, to decision-making, to the ability of businesses to plan for the future. What turned this from normal political tension into headlines wasn't a single event. It was the cumulative effect of multiple pressures happening at the same time. You had new policy decisions that raised questions. You had internal discussions within the administration becoming public. You had members of Congress from both parties expressing concerns about various issues. You had intelligence and defense matters being debated publicly. Then came what some saw as a tipping point. Actions that key members of Congress viewed not just as controversial, not just as partisan, but as worthy of the impeachment process. At that moment, impeachment stopped being just a talking point and became an active legislative effort. Now, you can agree or disagree with whether that's justified, That's not my job to determine. My job is to look at what happens next and what it means for the economy. Here's what concerns analysts from a business perspective. A president facing standard political opposition is one thing. A president facing formal impeachment articles, while there are also reports of potential cabinet changes, that's a very different level of uncertainty. In one scenario, the system feels stressed, but manageable. In the other, it feels like there could be significant disruption ahead. According to reporting from CNN and other major outlets, the White House is preparing for possible cabinet turnover after President Trump reaches the one-year mark of his term in January. At least one federal agency that could see change is the Department of Homeland Security. There have also been reports of tension involving other cabinet positions, though the White House has denied that major changes are imminent. A White House spokesperson stated, "The cabinet is not changing no matter how much some in the media wish that it would." But multiple sources have told news organizations that discussions about potential reshuffles are happening behind the scenes. Now, why does this matter? Economically? Because you've got cabinet officials who are supposed to be running day-to-day government operations, and if there's uncertainty about who will be in those positions in 3 months, 6 months, or a year, it becomes harder for businesses to plan. You've got senior officials trying to keep normal policy processes moving, while entire agencies are dealing with congressional oversight and public scrutiny. You've got foreign governments reading every headline and asking themselves a very practical question. Can the United States still make and keep long-term commitments right now? That's not a theoretical question. That's trade deals, that's defense agreements, that's sanctions enforcement, that's currency stability. And when foreign leaders are unsure about the answer, they start quietly hedging. They look for backup plans, alternative partners, independent arrangements. All of that has economic consequences. People sometimes think markets only react to numbers, interest rates, unemployment, earnings, inflation. But underneath those numbers is something much more fragile: confidence. Confidence that contracts will be honored. Confidence that rules won't change overnight. Confidence that institutions will hold up even if leaders face challenges. This impeachment moment, combined with reports of potential cabinet instability, targets that confidence in a way that's significant. Not just will the president stay in office, but who is actually managing the day-to-day machinery of government. Because here's the reality that market analysts understand. When a cabinet is perceived as potentially unstable, when there are questions about who might leave and who might stay, you don't just have a political story. You have a governance uncertainty. And governance uncertainty translates into economic uncertainty. Now, I'm not predicting catastrophe here. The United States has survived plenty of difficult moments: wars, assassinations, resignations, recessions. The system is resilient. It can handle more pressure than people often expect. But handling pressure has consequences. And right now, the pressure is significant. You've got a president fighting legal battles on multiple fronts. You've got a cabinet navigating between public duties and private concerns. You've got a Congress that's deeply divided. And you've got voters watching all of this, many of them tired, confused, and frustrated. That's not a formula for stability. That's a formula for volatility. From an analytical perspective, this impeachment push doesn't just raise the question of what happens to Trump personally. It raises a deeper question: how much stress can the system absorb before key actors, markets, allies, institutions start changing their behavior in ways that are hard to reverse? Because once behavior changes, once capital becomes more cautious, once alliances begin to shift, once predictability weakens, you don't simply flip a switch and return to normal. When you strip away the headlines and the partisan rhetoric, what this really comes down to is one thing: confidence in continuity. Not confidence in any particular person or party, but confidence that the lights stay on, the rules remain relatively stable, and the people in charge of key decisions are actually able to make them effectively. This impeachment effort, combined with reports of cabinet uncertainty, puts that continuity in question in a direct way. Because normally, even in a contentious presidency, you have three assumptions holding the system together. First, the president will remain in office unless there's a slow, deliberate constitutional process to remove him. Second, the cabinet will function as a stabilizing layer, managing day-to-day operations smoothly. Third, Congress will argue loudly but eventually pass necessary legislation to keep the government and economy functioning. Right now, all three of those assumptions are under some degree of strain, simultaneously. Let's start with the presidency itself. An impeachment inquiry is one thing. We've seen those before. They create headlines, they dominate news cycles, but they follow a familiar pattern. An impeachment resolution being filed with privileged status, however, especially one that's been attempted multiple times, creates a different dynamic. It signals that at least some members of Congress believe they have a constitutional duty to pursue this path. According to the text of H.Res. 537, the impeachment articles cite concerns about presidential powers, specifically regarding military action. The resolution alleges that President Trump authorized military strikes without proper congressional authorization. Now, whether you agree with that characterization or not, the fact that it's been formally introduced means it has to be addressed procedurally by the House. Markets don't necessarily react strongly to impeachment attempts that have no realistic chance of success, but they do react to the uncertainty created by constant political conflict. When business leaders call their advisors and ask what to make of all this, they're not asking about partisan politics. They're asking something far more practical. Do we plan for policy stability, or do we plan for 3 different possible scenarios in the next 12 months? That kind of question freezes decision-making. You don't break ground on a major facility if you have no clarity about what trade policy, tax policy, or regulatory environment will exist when it opens. You don't commit billions of dollars in capital when you suspect the framework might change significantly mid-project. So what do businesses do? They wait. They hold back. They reduce risk where possible. And when enough companies do that simultaneously, an economy that looked fine on paper suddenly feels sluggish. Now, let's talk about the cabinet situation. People sometimes underestimate how important cabinet stability is to market. Psychology. The president sets the vision, but the cabinet executes it. They translate broad statements into actual regulations, actual enforcement priorities, actual budgets. When a cabinet is viewed as strong, competent, and stable, investors can tolerate significant noise from the top. They think, yes, there's drama, but the professionals are keeping things running. But when that same cabinet faces questions about stability, when there are reports of potential departures or tensions, then confidence begins to erode. Recent reporting suggests that while President Trump is generally satisfied with his cabinet, there have been discussions about potential changes at certain agencies. Some officials have faced pressure over various policy matters. Others have reportedly consulted with personal attorneys about their positions. You don't typically see that level of legal consultation in a fully stable administration. When people responsible for defense, justice, treasury, and foreign policy start thinking about their own legal exposure or career protection, their focus naturally shifts. They're no longer primarily asking what's best for long-term policy. They're also asking what protects their own interests if the political situation deteriorates. That's not a criticism, that's human nature. But it has practical effects. Decisions can slow down. Risk-taking at the policy level decreases. Everyone looks for ways to avoid being exposed if circumstances change rapidly. From a market perspective, that creates a defensive posture in government operations. Then you layer Congress on top of this. You've got one faction pursuing impeachment, arguing that it's their constitutional duty. You've got another faction calling it political theater, saying it's an attempt to undermine an elected president through procedure rather than elections. And in the middle of that, Congress still has to fund the government, still has to address the debt ceiling, still has to pass basic legislation to keep things functioning. When impeachment becomes the dominant conversation, everything else gets more difficult. As someone who analyzes these situations, I don't need Washington to be pretty or harmonious. Economic progress has happened during plenty of messy political periods. But what markets do need is a basic expectation that essential functions continue, that financial obligations get met, and that laws get passed with enough predictability that businesses can plan ahead. When impeachment efforts start potentially interfering with budget timelines, when there are hints that some factions might use fiscal deadlines as political leverage, that's when risk calculations change. You see it in bond markets, you see it in credit spreads, you see it in volatility indicators. They don't scream immediately. They just start to signal, something here may not be as certain as it used to be. There's another aspect of this that doesn't get discussed much on cable news, but it matters considerably to financial markets. What gets revealed during an impeachment process? It's not just about the final vote. It's about what comes out during hearings, documents, communications, internal deliberations, private assurances that may contradict public statements. For markets, this gradual disclosure process is often more unsettling than the ultimate outcome, because every new revelation raises fresh questions about what else hasn't been disclosed. What else might be revealed? What other surprises might emerge? We've seen versions of this pattern before in corporate contexts. It wasn't just the initial scandal that damaged stock prices. It was the ongoing uncertainty about which other companies might be involved, which other practices might be questioned. Now we're potentially seeing a similar dynamic at the governmental level. If impeachment hearings start bringing cabinet deliberations, classified briefing details, and legal analyses into public view, markets may learn information that changes perceptions about how decisions were made over recent years. And markets strongly dislike discovering after the fact that the reality behind closed doors was significantly different from the public presentation. People often ask, is this like Watergate? Is this like the Clinton impeachment? Is this like anything we've seen before? And my honest assessment is, not quite. The specific circumstances are different. The charges are different. The political environment is different. But more importantly, the economic context is dramatically different. We didn't have this level of global debt during previous impeachment crises. We didn't have this degree of geopolitical tension. We didn't have markets connected through algorithms that can react in milliseconds to spikes in uncertainty. So, when you layer impeachment proceedings on top of a highly leveraged, hyper-connected, speed-driven market structure, you create a very delicate situation. A single leaked document can move $1 trillion in market value in minutes. A single cabinet official's resignation announcement can light up trading desks in New York, London, and Tokyo before most of the public has even seen the news. That speed and interconnection is relatively new, and it creates unique challenges. So what do investors do in this environment? They don't go on television and announce panic. They adjust quietly. A bit more cash in portfolios, a bit less exposure to high-risk assets, perhaps more gold holdings, shorter duration on certain bonds, more hedging around sectors directly tied to government policy. They don't panic. They reposition. And if this impeachment process continues, if cabinet uncertainty increases, if we see more emergency congressional sessions, more unexpected announcements, more surprising testimonies, that repositioning will intensify, not because markets have a political preference, but because markets fundamentally dislike not knowing how the situation will resolve. From an analytical standpoint, the crucial question is this: does this impeachment process lead to clarity, or does it lead to prolonged uncertainty, where nobody knows who's truly in charge, what the rules are, or how long the ambiguity will last? If it produces clarity, even painful, difficult clarity, markets can process that. They always have. If it produces extended uncertainty with no clear timeline for resolution, that's when you start seeing deeper economic impacts. When a country goes through significant political turbulence like this, the rest of the world doesn't just watch passively. They adjust their own strategies. They test boundaries. They probe for advantages. Let's start with foreign governments. Whether we're talking about Russia, China, Iran, or other powers, they all operate with one fundamental principle. When your competitor is distracted, you quietly advance your own interests. If you're a strategic thinker in one of those capitals, and you see the United States consumed with impeachment proceedings, cabinet speculation, and intense domestic political conflict, you recognize an opportunity. You don't necessarily launch dramatic initiatives. That's too obvious and too risky. Instead, you make smaller, more calculated moves. You push harder in trade negotiations. You delay agreements that were close to completion. You test boundaries in disputed regions with actions that are deniable or ambiguous. You make offers to U.S. allies that sound slightly more attractive than before. You understand that American attention is focused inward right now, not on the long-term global chess game. And when a superpower is in survival mode domestically, there's often less bandwidth for managing complex international situations. U.S. allies notice this pattern too. They receive the same intelligence briefings, read the same headlines, watch the same congressional proceedings. When they observe impeachment efforts accelerating, reports of cabinet instability, and Congress deeply divided, they quietly ask themselves, if a major crisis happens in our region next year, can we count on Washington being fully engaged and responsive? Or will it be preoccupied with internal battles? They won't say that publicly at joint press conferences. They'll discuss it privately in their own government meetings. And the conclusions they reach shape decisions that may not become public for years. Diversifying weapons procurement, developing alternative trade routes, gradually reducing dollar holdings in reserves, signing deeper agreements with powers that aren't experiencing the same domestic turbulence. Each individual move is modest. None sounds like a major headline. But over time, they accumulate into a gradual shift away from exclusive reliance on U.S. leadership and toward a more diversified approach. That erosion, that steady, quiet diversification of international relationships, matters to markets far more than dramatic speeches about permanent alliances, because it represents a real, structural change in how the world operates. Now let's discuss the financial sector. Because banks are extraordinarily sensitive to uncertainty, they don't overreact loudly, they adjust quietly. They sense instability long before it becomes obvious to the general public. Banks fundamentally dislike two things: not knowing who will be making key decisions, and not knowing what the regulatory framework will be. Impeachment proceedings combined with potential cabinet changes hit both concerns simultaneously. If you're a bank executive, you're considering questions like, will the next Treasury official have the same approach to financial regulation? Will the Justice Department's enforcement priorities shift significantly? Will sanctions policy change because different personnel take over during a critical period? Could actions that are acceptable under one administration become problems under different leadership? That type of uncertainty doesn't necessarily trigger an immediate crisis, but it does change institutional behavior. You tighten lending standards slightly. You become more cautious on marginal credits. You hold more liquidity than strictly necessary. You pull back from exposures that might attract regulatory scrutiny if the political climate shifts. And when an entire sector adjusts its behavior simultaneously, you get what analysts call a credit chill. Not a freeze, not a collapse, just a chill. But a chill at the wrong economic moment can push an already fragile situation several degrees closer to recession. Investors remember 2008 far more vividly than they typically acknowledge. They remember what happens when confidence disappears from the banking system and credit markets freeze. So when they observe impeachment proceedings, cabinet uncertainty, potential government funding disputes, and policy being made through late-night announcements, they don't wait for an official crisis declaration. They begin building in what's called a political risk premium. You see it as slightly higher yields required on certain bonds, lower valuations on certain equity sectors, and increased volatility around key political dates. Impeachment votes, major court rulings, budget deadlines. None of that means the system is about to collapse tomorrow. But it does mean that capital is no longer treating U.S. political uncertainty as negligible, and that represents a meaningful shift. Some people ask, in a moment like this, what should investors do? It's a fair question because market turbulence affects retirement accounts, pension funds, and savings that millions of Americans depend on. Let me walk through how experienced investors typically think about situations like this. First, you don't wake up and say, impeachment news, sell everything. That's not how long-term wealth gets built. What sophisticated investors do, instead, is analyze multiple layers. Core economic needs. Are people still going to need energy, transportation, insurance, healthcare, and essential consumer goods, regardless of who occupies the Oval Office? Yes, absolutely. Financial conditions. Are we heading into an environment where credit becomes tighter, volatility increases, and some companies find they can't refinance their debts as easily? Quite possibly. Opportunity assessment. Will there be fundamentally strong businesses that become temporarily undervalued because markets can't separate political noise from long-term value? Almost certainly. When you see that combination, what do? You prepare, you wait, and you act selectively. Preparation means you don't overextend yourself right before conditions become turbulent. You don't load up on leverage. You don't bet everything on a single prediction about how the impeachment will end. You ensure you have more liquidity than you strictly need. You make sure your own financial position could handle a storm. Many experienced investors maintain higher cash positions than seems optimal during calm periods. People sometimes criticize this approach, saying it reduces returns. That's true until turbulence hits. When markets are calm, excess cash looks inefficient. When markets panic, excess cash represents opportunity. Waiting means you don't confuse activity with strategy. Just because financial news is flashing urgent updates, just because social media is filled with predictions of doom or triumph depending on political perspective, that doesn't mean you need to act today. Sometimes the smartest move is observation. Watch which sectors show weakness first. Watch which companies start issuing cautious guidance. Watch which balance sheets suddenly look more fragile. When credit becomes more expensive and uncertainty increases, patience isn't passive, it's strategic. Acting selectively is the final component. When impeachment risk, cabinet, uncertainty, and economic concerns all get priced into markets indiscriminately, you start seeing mispricings. A business whose success genuinely depends on close government relationships probably deserves a significant discount during political turmoil. But a business that sells essential products to mainstream consumers for the next several decades probably doesn't deserve the same discount, even though both might decline together when fear is high. Markets don't always make that distinction, especially when emotion runs strong. So experienced investors look for companies with minimal direct exposure to political decisions, companies with clean balance sheets, companies whose products or services aren't optional luxuries, companies whose management teams have proven they can navigate difficult periods. And when those companies go on sale, simply because investors are generally fearful, that's when opportunities emerge. Not recklessly, not frantically, but methodically. This all brings us back to the same fundamental point. This impeachment effort isn't just about one person's political fate. It's about how long the uncertainty persists, how much institutional confidence gets damaged along the way, and how deeply trust in governmental stability gets shaken. The legal system will proceed with its processes. Congress will do what it believes necessary. The cabinet will make its own decisions. But markets are already calculating a different question. How do we protect capital if this situation extends longer than anyone currently expects? And that calculation, more than any speech, any rally, any viral social media post, is what will shape the investment landscape for the coming year. If you really want to understand how delicate this moment is, you can't just focus on the major speeches or the final impeachment vote. You have to pay attention to what happens around the key moments. The late-night information leaks, the emergency press briefings, the no comment responses from cabinet officials, the surprise subpoenas. Markets are no longer slow, deliberate entities that digest information over weeks. Their response systems are directly connected to breaking news. Picture this scenario. It's a Tuesday afternoon. Markets are relatively stable. Traders are focused on interest rate expectations and corporate earnings. Then a headline appears. Senior administration official cooperating with congressional inquiry. White House reportedly surprised. Within seconds, trading algorithms scan those words, compare them against millions of historical patterns, and begin automatically selling anything associated with political risk. Financial sector stocks react. Defense contractors' share prices fluctuate. Certain industries tied to government contracts experience sudden selling pressure. A few minutes later, an unconfirmed report circulates. Resignation letter reportedly drafted, may be submitted within 24 hours. No confirmation, no official statement. But in modern markets, you don't wait for confirmation. You price in the possibility immediately. That's how these rapid volatility spikes occur. Sudden surges in uncertainty that feel like someone repeatedly flipping the lights in a crowded theater. We've experienced versions of this before, though never in quite this configuration. In 1974, the gradual revelations of Watergate eroded confidence slowly, but markets and media moved at a fundamentally different pace. You had time to read the morning newspaper, think about implications, and discuss them before anything significant moved in markets. In 1998, with Clinton's impeachment, there was what analysts called scandal fatigue. People were exhausted by the coverage, but the underlying economy was booming. The technology bubble was inflating rapidly. There was so much speculative energy that impeachment felt like background noise to many investors. Today represents a very different combination. You have a highly leveraged global financial system, algorithms executing trades based on headlines, social media amplifying every rumor, geopolitical tensions already elevated, and a political environment where both sides treat every institutional conflict as existential. So when an impeachment effort moves from theoretical to active congressional resolution, it impacts this hypersensitive system in ways that neither 1974 nor 1998 had to navigate. Here's what many people miss about volatility. It's not just a technical chart pattern. It's emotion expressed through numbers. Every spike in volatility represents a collective flinch, a moment of heightened uncertainty across thousands of market participants simultaneously. And when those moments of uncertainty start occurring more frequently, investors adapt their strategies. Investment funds that pride themselves on stability start using more protective hedges. Short-term traders tighten their risk management. Options markets start pricing in larger potential price swings around key dates. Impeachment hearing days, witness testimony sessions, cabinet announcements, Supreme Court rulings related to executive power. All that protective activity, all that hedge buying, has a secondary effect. It makes sudden market moves more severe when they finally occur. Because when everyone is braced for impact, small shocks don't feel small anymore. They feel like confirmation that something significant is happening. Now let's discuss something quieter but potentially more concerning: public fatigue. At the start of a major political controversy, people feel intensely engaged. They pick sides. They argue passionately. They pay close attention. But as months pass, as impeachment proceedings continue, and as hearings accumulate, the public often begins to experience numbness. Instead of outrage, you get resignation. Instead of, "This is shocking," you hear this again. Instead of intense interest, you see people tuning out. For democratic institutions, that's a serious long-term concern. For markets, it's complex. On one hand, fatigue can dampen the emotional reaction to each new revelation. On the other hand, fatigue erodes the fundamental belief that the system can self-correct effectively. People stop saying, "This is bad," but our institutions will address it. They start saying, this is bad, and maybe our institutions are part of the problem. That's where impeachment stops being just about a single president and starts becoming a broader question about the entire governmental architecture. And if investors begin to believe that courts are politically captured, that regulators are politically motivated, that the central bank is politically influenced, and that every agency is just one election away from being repurposed as a partisan weapon, then you're not just trading on economic fundamentals anymore. You're trading on institutional legitimacy. Experienced analysts have long understood that trust is the ultimate foundation of economic value. You can have abundant resources, advanced technology, military strength, and global trade routes. But if people don't trust your contracts, your courts, your elections, your data, then the value of your currency, your promises, your bonds begins to deteriorate. This is the deeper risk behind an impeachment effort combined with cabinet uncertainty. It's not simply whether Trump stays or goes. It's that, in the process, we might erode another layer of confidence in how the American system functions overall. Each side will claim they're defending democracy. But if the public emerges from this believing that whoever loses an election will simply attempt to impeach the winner next time, then we've transformed an extraordinary constitutional mechanism into a routine political weapon. And routine weapons get priced into expectations. You start assuming every presidency will face some version of this level of institutional warfare. You start assuming every major policy may be litigated, blocked, or reversed based on which party controls which chamber during which 2-year period. That's not immediately fatal to the system. But over 10, 20, or 30 years, it changes the risk premium investors assign to American governmental stability. Let's return to the cabinet situation for a moment, because this is where the brink of collapse language that's being used becomes meaningful. When cabinet officials begin to worry, they might be drawn into legal complications. They think across multiple time horizons. Immediate. How do I get through this week without being forced to testify about something I never wanted to be involved in? Near term. If the president survives this challenge, what happens to my professional reputation? If I was too publicly loyal, will that hurt me later? Long term. If the president doesn't survive, how will history and future employers evaluate what I did or didn't do during this period? You can see why many officials suddenly become very comfortable with terms like interim and acting. Interim positions, acting secretaries, temporary arrangements, all of that creates flexibility, but also instability. That fluidity at the top of key departments might not concern voters much. Many have grown accustomed to frequent personnel changes, but it concerns people making major capital allocation decisions because when you ask who sets energy policy, and the answer is, well, technically, it's this acting official who may or may not be replaced depending on how certain congressional votes go and what a few key senators decide. You're not exactly filled with confidence to approve a found 15-year, multi-billion-dollar infrastructure project. So again, plans get delayed, decisions become more cautious, time horizons shrink, investment cycles slow. Here's an irony that's hard to ignore. Impeachment is supposed to be a constitutional emergency mechanism, used rarely and carefully when normal. Political processes can't adequately address alleged serious misconduct. But the way it's being deployed now, in a 24/7 hyper-partisan media environment, with multiple attempts over a single term, with emergency procedural maneuvers and cabinet speculations swirling simultaneously, it risks becoming something else, a recurring feature of American politics. And recurring emergencies aren't really emergencies anymore. They become normal business conditions. When the extraordinary becomes ordinary, you don't react with shock. You react by adjusting your baseline expectations. That new baseline looks like lower long-term confidence in governmental stability, more frequent volatility spikes in markets, slower capital formation and business investment, and a quiet shift of trust out of political promises and into tangible assets, resilient companies, and liquid reserves. From an investment perspective, the impeachment vote itself is not the end of the story. It's one data point among many. What matters far more is how many institutions appear weaker afterward, how many officials resign in the aftermath, how many governmental norms are abandoned and never rebuilt. How long does it take before markets feel that stable, professional management has returned to the basic machinery of government? That timeline, not the cable news countdown clock, is what will determine how deep and lasting the economic impact becomes. When a country reaches this level of political saturation, where every hour feels like a new crisis, something subtle happens that most people don't notice until it's already reshaping the economic landscape. The public stops caring intensely. Not in a cynical way, not in an angry way, but in a tired, deeply exhausted way. And that fatigue has real economic consequences, because functional democracies aren't powered by perfection. They're powered by participation, by engagement, by a sense, even a fragile one, that the system still basically works. When you exhaust people, when you bombard them with crisis after crisis without resolution, something breaks. Not loudly, but quietly. The public shifts from passionate outrage to weary shrugs. At the beginning of impeachment discussions, people watch every update, debate every angle, share every development. But by month 2, 3, 4, you start hearing different phrases. I'm tired of all this. Nothing ever changes. They're all the same. Wake me when it's over. That last phrase, wake me when it's over, represents perhaps the most dangerous sentiment in democratic politics, because when the public mentally checks out, bad actors check in. Institutions that rely on public scrutiny begin to drift. Decisions get made with less transparency and more self-interest. And the long-term cost is trust, the one thing markets cannot replicate with algorithms, mathematical models, or sophisticated trading strategies. Now, let's examine the two potential outcomes everyone is quietly considering, though neither is simple or clean. Path 1. The impeachment effort fails. Trump survives the congressional vote. He remains in office. The cabinet situation stabilizes to some degree. He keeps governing. The short-term reaction from his supporters would likely be celebratory, vindication, victory, proof that the effort was unjustified. But markets think differently than political bases, because failure of impeachment doesn't end uncertainty. In many ways, it extends it. If the impeachment fails, you get a president who's still in office, but more politically embattled, an even more polarized Congress, with deeper divisions, state-level investigations likely intensifying, ongoing legal challenges on multiple fronts, a cabinet that may be filled with more loyalists than technocratic stabilizers, and a country that now broadly believes impeachment is primarily a partisan tool rather than a constitutional safeguard. That's fuel for political mobilization, but it's problematic for economic confidence. For markets, that scenario means volatility doesn't fade, it potentially accelerates. Why? Because investors understand something crucial. A politically wounded president who retains power can be far harder to predict than either a triumphant one or a removed one. Uncertainty doesn't resolve, it morphs. Policy becomes more reactive, more improvisational. Regulatory decisions become more unpredictable. International partners grow more cautious about long-term commitments. The chaos continues, but without the pressure release valve of an active impeachment process to absorb some of the political energy. Path 2. The impeachment succeeds. This is the scenario nobody really wants to fully contemplate because it forces the country to confront constitutional questions we haven't faced since Nixon's resignation. If impeachment actually succeeds, which would require significant defections from the Republican majority in the House and an even more dramatic shift in the Senate, you don't get stability the following morning. You get shock, profound shock. You get millions of supporters convinced the democratic system was subverted. You get millions of opponents convinced democracy was preserved. You get a transition of power under heavily contested circumstances. you get immediate cabinet resignations. You get lawsuits challenging the legitimacy of the process itself. You potentially get some states threatening political retaliation through congressional actions. Markets strongly dislike shock of this magnitude. They would price it like a severe systemic event, fast, widespread, and with assumptions that conditions may deteriorate further before improving. This scenario could produce several days of extreme volatility, possibly a multi-week market correction. But, and this is important, if the transition stabilizes, if new leadership demonstrates competence, if the cabinet gets rebuilt with credible professionals, confidence can begin returning. Slowly, carefully, but it can return. Investors don't need perfection. They need predictability. If impeachment succeeds and the system demonstrates it can manage the aftermath effectively, markets will treat the disruption as painful, but ultimately manageable. The critical variable is how investors perceive the process. They're not just watching impeachment votes. They're watching behavioral signals. Are major companies delaying hiring decisions? Are CEOs pausing significant investments? Are banks quietly tightening credit without making public announcements? Are foreign investment funds gradually shifting out of U.S. assets? Are bond spreads widening? Even without hard economic data changing dramatically, these subtle indicators always emerge first. When systemic confidence is evaporating, you can't hide it from credit markets. Credit markets sense when leadership is fractured, when institutions are unstable, when the system feels fragile. And, right now, credit markets are behaving as though something significant is approaching. Not necessarily tomorrow morning, not necessarily next week, but soon enough that cautious positioning makes sense. The consistent principle that experienced investors follow is this: patience is a strategic advantage. Don't be reckless when the world is uncertain. Don't chase euphoria during market peaks. Don't panic into losses during market fear. Stay liquid. Stay rational. Stay prepared. Patience isn't exciting. It doesn't generate dramatic headlines. It doesn't earn social media applause, but it works over time. Because patience allows you to survive the storm, and then, when everyone else is too frightened to think clearly, you can act from a position of strength. In a moment like this, the sophisticated investor isn't asking, is the president guilty? Is the impeachment justified? Which political side is correct? The sophisticated investor is asking, how long will this uncertainty persist? How deep will the institutional damage go? Which companies remain fundamentally solid regardless of who occupies the Oval Office? Because in the long run, those are the questions that actually determine investment outcomes. This brings us to the final point, and it's perhaps the most important. What we're watching isn't just a political drama. It's a stress test of American institutions at a scale we haven't seen in decades. Every democracy has mechanisms for handling crises, for checking power, for enforcing accountability. The impeachment process is one of those mechanisms. But mechanisms can be overused, misused, or transformed into something different from their original purpose. If this impeachment effort succeeds in holding a president accountable for genuine constitutional violations, the system will have worked as designed, however painfully. If this impeachment effort fails and becomes viewed as purely partisan theater, it weakens the mechanism for future genuine crises. If this process drags on inconclusively, creating prolonged uncertainty without resolution, it damages confidence in the entire system. Markets are trying to price all three possibilities simultaneously. That's why you see such volatility, such uncertainty, such difficulty in forecasting. The truth is, nobody knows exactly how this will resolve. Not the politicians, not the analysts, not the investors, not the talking heads on television. We're all watching the same unfolding situation in real time, trying to make sense of incomplete information and uncertain outcomes. What we do know is this: the combination of impeachment proceedings, cabinet uncertainty, political polarization, and global economic fragility creates a uniquely challenging environment. For the average person watching this, for the retirees depending on their savings, for the workers worried about their jobs, For the families trying to plan their futures, the message is simple. Stay informed, but don't panic. Understand that markets go through difficult periods and emerge on the other side. The American economy is resilient. American institutions, for all their current stress, have survived worse. But also understand that this moment matters. The decisions being made right now in Congress, in courts, in cabinet meetings, in corporate boardrooms, in investment committees will shape the economic landscape for years to come. So, pay attention. Ask questions. Demand accountability from leaders on all sides. Don't accept simple narratives or partisan talking points. Look at the actual evidence, the actual policies, the actual economic indicators, because at the end of the day, whether you're a supporter or opponent of this president, whether you think this impeachment is justified or not, we all share the same economy, the same markets, the same need for stable, functional institutions that can weather political storms, and that shared stake in stability, that common interest in a system that works, is ultimately more important than any single political battle, any single presidency, any single impeachment vote. Thank you for watching. If you found this analysis helpful, please subscribe to the channel. We'll continue monitoring this situation closely and bringing you updates based on verifiable information and serious economic analysis. Remember, in times of uncertainty, knowledge and patience are your greatest assets. Stay informed, stay rational, and stay focused on what truly matters for your long-term financial security.